For most of human history, control did not arrive suddenly. It arrived quietly, slowly, wrapped in convenience, safety, and progress. People rarely noticed it happening, because each step forward seemed reasonable, even necessary. And that is exactly how the future of money is being built right now. Most people believe financial control looks like force, like confiscation, like authoritarian power, but the truth is more subtle. The most powerful systems of control are the ones people willingly accept. The ones that promise stability in exchange for obedience. The ones that trade freedom for efficiency and uncertainty for security. To understand where the financial system is going, we need to confront a difficult idea. Control in the modern world does not come from soldiers or police. It comes from infrastructure, from systems so deeply embedded in daily life that opting out feels impossible, from platforms that decide who can transact, who can save, who can borrow, and who can survive economically. Money is no longer just a tool. It is becoming a mechanism of behavior. For centuries, financial power depended on physical limits. Gold had to be mined, coins had to be transported. Banks had to balance ledgers by hand. Control was imperfect, slow, and often resisted. Even the most powerful empires could not see every transaction or track every obligation. That limitation is disappearing. Digital money changed the nature of control by removing friction. Transactions became instant. Records became permanent. Distance stopped mattering. And for the first time in history, financial activity could be monitored, analyzed, and influenced in real time. This shift did not begin as a conspiracy. It began as a solution. As economies grew more complex, governments and financial institutions faced a problem. The system was too big to manage manually. Fraud was increasing. Tax collection was inefficient. Crises were spreading faster than regulators could respond. The answer was automation, digitization, centralization. At first, this seemed harmless. ATMs replaced tellers. Online banking replaced branches. Cards replaced cash. Each step saved time. Each step reduced cost. Each step increased convenience. But with each step, something else was lost. Anonymity faded. Informality disappeared. Transactions became traceable. Behavior became legible. And once behavior can be seen, it can be shaped. The modern financial system no longer just records what people do. It predicts what they will do next. Algorithms analyze spending patterns, saving habits, debt behavior, and risk profiles. Credit scores are no longer simple measures of repayment. They are behavioral models. They estimate how compliant, stable, and predictable a person is. In this system, access to money becomes conditional. This is not a future scenario. It is already happening. Banks freeze accounts based on algorithmic flags. Payment processors deny service to certain industries, opinions, or behaviors. Entire populations can be excluded from the financial system with a software update. And because the system is privatized, the decisions are often opaque, unaccountable, and irreversible. The most important shift is this: money is no longer neutral. In the past, money was a bearer instrument. If you held it, you could use it. Today, money increasingly requires permission. Permission to open an account. Permission to transact. Permission to convert, withdraw, or transfer. This transforms money into a governance tool. Governments have always wanted this level of control, but they never had the technology to implement it fully. Now they do. Central bank digital currencies, or CBDCs, represent the clearest expression of this future. On the surface, they look like modernized money, faster payments, lower costs, financial inclusion, efficiency. But beneath that surface lies a structural change. A CBDC allows a central authority to issue money directly to individuals without intermediaries. This means the same institution that sets monetary policy can also monitor usage, enforce conditions, and alter functionality. Money can be programmed. It can expire, It can be restricted to certain goods. It can be limited by geography. It can be disabled instantly. It can be targeted to specific behaviors. This is not speculation. Pilot programs already demonstrate these capabilities. The justification is always stability. After every crisis, the same argument returns. The system failed because it lacked oversight, because bad actors exploited loopholes, because regulators could not react fast enough. And so, more control is presented as the solution. What is rarely discussed is the cumulative effect. Each layer of control reduces autonomy. Each safeguard increases dependency. Each emergency measure becomes permanent. History shows us this pattern clearly. Extraordinary powers granted during crises are rarely surrendered afterward. They become normalized, institutionalized, invisible. The financial system is following the same trajectory. Private banks, once the dominant gatekeepers of money, are slowly being absorbed into a larger framework of regulatory coordination. Compliance requirements increase. Reporting obligations expand. Risk tolerance shrinks. Banks no longer decide freely whom to serve. They enforce policies created elsewhere. At the same time, cash is being quietly marginalized. Not banned outright, just discouraged. Made inconvenient, restricted, framed as unsafe, dirty, or criminal. Cash represents something dangerous to centralized control, unrecorded exchange, informal trust, economic life outside the system. Eliminating cash does not require force. It only requires convenience. Digital alternatives become so dominant that cash feels obsolete. Eventually, those who rely on it are seen as suspicious. This creates a society where economic participation requires system compliance. And once money becomes a permission system, dissent becomes expensive. The future of financial control does not depend on ideology. It depends on incentives. People will accept control if it offers stability. They will trade freedom for predictability, especially after repeated crises. And crises are not going away. Debt levels are unsustainable. Asset bubbles are systemic. Inequality continues to rise. Demographics strain welfare systems. Climate risks disrupt supply chains. Geopolitical fragmentation threatens global trade. Each of these pressures increases the likelihood of disruption. And each disruption justifies more centralized intervention. This is where technology and finance converge. Artificial intelligence does not just analyze markets. It governs them. It adjusts liquidity in real time. It flags risk before humans can see it. It optimizes systems based on predefined objectives. The question is not whether this technology will be used. It already is. The question is who defines the objectives. Efficiency is not neutral. Stability is not neutral. Risk reduction is not neutral. Every system encodes values. If the primary objective is system stability, individual hardship becomes acceptable. If the primary objective is inflation control, unemployment becomes a policy tool. If the primary objective is compliance, exclusion becomes normalized. This is how control becomes invisible. No one announces it. No one votes on it. It emerges from technical decisions made in response to crises. And once implemented, it is extremely difficult to reverse. At the same time, resistance is fragmenting. Alternative systems exist. Cryptocurrencies, informal networks, local exchange systems. But each faces increasing pressure. Regulation tightens. Access points are monitored. On-ramps and off-ramps are controlled. The system does not need to eliminate alternatives. It only needs to contain them. The irony is that many of these alternatives were created to escape control, yet they often rely on centralized infrastructure to function. This creates a paradox. True financial autonomy becomes harder precisely because the system grows more complex. What emerges is a layered world. At the top, fully integrated participants enjoy seamless access, credit, and convenience. At the margins, excluded groups operate in constrained spaces, monitored and limited. Between them lies a gray zone of conditional access. This is not science fiction. It is an extension of existing trends. Financial identity becomes as important as legal identity. Your transaction history becomes your reputation. Your spending behavior becomes a measure of trustworthiness. In such a system, punishment does not require prison. It requires denial, denied credit, denied payments, denied access. Control becomes administrative, not violent. This is why the future of money matters more than ever. Not because money itself is evil, but because whoever controls money controls behavior at scale. Throughout history, empires understood this instinctively. They taxed, debased, rationed, and restricted currency to enforce obedience. What they lacked was precision. Today, precision is total. The danger is not that control will be used maliciously. It is that it will be used routinely, automatically, without moral consideration. Systems do not ask whether something is fair. They ask whether it meets criteria. And criteria can change. The final transformation is psychological. When people grow up in a world where money is conditional, they internalize the rules. They self-censor. They adjust behavior. They avoid risk. Control no longer needs enforcement. It becomes self-regulation. This is the most powerful form of control ever created. Not because it is imposed, but because it is accepted. The future is not a single event. It is an accumulation of small decisions. Each time stability is chosen over autonomy. Each time efficiency outweighs freedom. Each time crisis justifies expansion. The system grows, and once complete, it does not feel like control. It feels like normal life. The question is not whether this future will arrive. It is already arriving. The real question is whether people will understand it in time to shape it. Because systems designed without public awareness tend to serve narrow interests. And systems built in fear tend to sacrifice liberty. Money has always been about power. But for the first time, power can be exercised at the level of every transaction, every day, everywhere. This is not a warning of collapse. It is a warning of permanence. A world where money never forgets, where access is conditional, where behavior is priced. And once that world is complete, leaving it will be harder than entering it ever was. Understanding this does not require rejecting technology or progress. It requires recognizing trade-offs. Every system gives something and takes something. The future of money will define what is given and what is taken. And that choice is being made now, quietly, line by line, policy by policy, update by update. If you want to understand power in the modern world, do not look at armies or borders. Look at money. Because the final form of control is not force. It is design. And once designed, it governs everything.